Well, hi everyone, and thanks so much for joining us for this webinar for Intelligent Investor. And of course, we started our Intelligent Investor Australian Equity Income Fund secondary offer just on Monday, and that's going to be running until the Friday, the 30th of August. So not tomorrow, the next Friday, so we've still got a bit of time to go. And I'm Tom Wilson. I'm the investor educator at InvestSmart and Intelligent Investor. But first, just a reminder that we provide general product advice only, not any type of personal financial advice. And the reason why we're here, I'll just make it a bit more readable. Like I mentioned, the secondary offer has started. And how that works is that once a year, so every quarter, we get one of our ETFs, our exchange traded funds, and we offer it to the public, and they're able to apply directly through Intelligent Investor and get units inside that fund. And that means that you don't pay brokerage, which is one benefit. Or if you're someone who doesn't use a broker, this is the way you can do it. You also don't pay any bid or ask spread. That's the buy-sell spread. We give you the unit at the net asset value, and that's determined by the closing net asset value at Friday, 30th of August. So basically, you get those benefits when you apply directly through us. And Nathan is waiting to come on board, so don't worry, it's not just me today. And how this works is that we'll get Nathan to run through all of the different features, what he's talking about, what he's seeing in the market, etc. Great place to ask questions. So definitely ask questions, and I'll do my very best to try and cover them off on the side. So we're getting a few just quick little, maybe might need to refresh the page if you can't see it. People are saying they can, they can't, but it looks like most people can see the stream. So basically, when you're applying for this, you can actually use your holder identification number. So if you've got a share trading account, brokerage account, it means that you can apply, put that number in, and we'll send the units to that brokerage account. If you haven't done one of these before with Intelligent Investor, it'll go to the share registry first, and then you just simply transfer it across. And that way you can then trade it, buy and sell on the market itself. The management fee is 0.97%. And that's no performance fees with this particular ETF. So you can head to offer.intelligentinvestor.com.au/INIF, and that's the ticker code should you want to find out some more information. But we'll obviously upload all of this for you, and there's the bonus income special report. There's so many things to mention at the start here, and we'll actually send that to you by email tomorrow, along with a link to the copy of this recording. But thanks so much for waiting there. And what we'll do now is we'll introduce Nathan Bell, and Nathan Bell is the head of research at Intelligent Investor and the portfolio manager. Nathan, thanks so much for joining us and waiting there while I got through all I had to get through.
Thank you, Tom, and welcome everyone watching and listening. You'll notice that the title of the presentation is not 5 stocks to make an income portfolio, or 5 stocks better than the banks. I'm going to talk about a few stocks today in particular, but I'm not going to just regurgitate that special report, which you can obviously read at your own leisure. But if you do have any questions about those stocks, by all means, let us know in the Q&A session. I've got a lot of slides. This particular fund always has the most slides because there's always new people listening in, and I want to explain what it is we're actually trying to achieve, because we're really about an income fund that actually genuinely outperforms the index. And that's not what most income funds are designed to do. Most income funds are just designed to maximize the yield, which basically guarantees they're going to underperform, but you end up paying performance fees because they put some other sort of benchmark on there, which is just an arbitrarily low number. It might just be 8%, or it might be the RBA cash rate, or it might be something to do with franking credits. But the idea behind our fund, and the reason why it has a history going back to about 2002 of outperforming by a couple of percent a year, is because we are trying to buy businesses that can grow their profits faster than the market and can grow their dividends much faster than the market. And so that's really the crux of what you need to understand about how we manage the money, and you'll get that through the stock ideas that I'll go through shortly. But I think it's quite different approach to most income funds that most people think of. They really just want to maximise the dividend today and maximise the franking credits today. But the problem with that is that you're guaranteed to underperform the market by doing that. And I'll talk about some of those things to watch out for. But I've got some of those points in the slides that I don't necessarily want to go over today because I've got so much other stuff I want to cover. But you will get a copy of the slide deck so you can go through those, and it's self-explanatory. But if you do have any questions about that, either this morning or later on, you can send them in to us and we'll be more than happy to answer. But I think it's just very clear to explain what this fund is about. It is genuinely trying to outperform the market, and therefore you can't just buy the biggest yielders because that guarantees you'll underperform. Because basically any company that is maximising its dividend and paying huge dividends out of its profits can't usually grow its profits. That's why it's doing it. It doesn't actually have many investment options in the business to grow its earnings. So that's really the principle that applies. So I'm not going to go through our approach and skin in the game and all these sorts of things. I've explained what we're this fund really came out of our old model portfolios from the subscription business that I'm sure many people listening are members of. The model portfolio goes back to, I think it was 2001 or 2002, and it always done 2% outperformance over the long term. There was periods like when I was research director between 2011 and 2015 where I think we were doing 4% a year. Like it was just a really great period because 2011 stocks were still so cheap after the GFC. So you had this huge run, and I'm going to talk about the performance of the fund in a moment. But we are aiming for that 1 to 2% per annum, and therefore that's why you can't just maximise the yield. But it's the value in investing and the value in businesses is the most valuable businesses are the ones that can grow their earnings and dividends over time. They're the ones that get the big multiples. So we're trying to buy them before the market spots them. We're not trying to just load this portfolio up with banks and iron ore miners, which you don't need to pay us a fee to do that. You can just buy an index fund. But that's how you outperform. You've got to do something different. So I'm not going to go through the matter of compound interest. I hope most people understand that. But the point is a 1 or 2% difference over time in your returns over a long period of time makes a huge difference in actual dollars. So that's really why we're trying to outperform still. And we've done it for so long. And because our funds aren't managing billions of dollars, there's no reason we can't continue to outperform by 2%. So I think I've covered most of these. These are just remember the rule of 10%. It's one of my favourites. Whenever you see, probably like the iron ore miners are a good recent example. If you see any stock that's trading at near a 10% income yield, watch out because usually that means the dividend's going to get cut. The important thing to remember is the market's not stupid. There are people like me, thousands in Australia. I think we've probably got the most overanalyzed market in the world would be my guess. Of very smart people, intelligent people trying to do the right thing and looking at these companies. So they're not just going to ignore a stock offering a 10% dividend yield alone, unless there's something wrong with that stock or that business, or there's an expectation that dividend is going to be cut. So just remember, if you see something that looks too good to be true, it usually is. And that's really a guiding point, I think, behind our fund. And I say just the bottom one there is, it's a highly liquid fund. Often you see there are days when there might not be much trading in the listed ETF, but that doesn't mean there's no liquidity. That just shows you the demand or not for the stock. There's huge liquidity in the fund. The average market cap is tens of billions of dollars in the fund. But also our ETFs, all our ETFs, not just the income fund, are all governed by the ASX listing rules on liquidity. And so we only have a very small amount of headroom where we can buy sort of smaller mid-cap type stocks. I'm going to talk about one of those today, but there are some of these great businesses. RPM Global's one that we've bought more recently that had doubled there up until recently. So it's been a huge winner to the fund, and sometimes it's worth sacrificing a little bit of yield for that sort of growth, especially in a more inflationary environment. But we can't buy many of those stocks, and sometimes that impacts our liquidity, and we have to hold a bit more cash for that reason. So it's really important. It's not that any investor needs to worry about this, but it's really important that me and the team are always trying to maximise the returns we get from the limited amount of small caps that we can buy. So I just want to do this exercise, and people who have seen these webinars before will know the answer, but I'm sticking with the same example, and it just underlies the focus of the fund. and why companies that can grow their dividends are far more valuable than the traditional companies that you expect to buy in an Australian portfolio that pay bigger yields. So the example is, which income stock would you choose? There's Company A. So this is a company that I recommended way back when I was a much younger man, just after the GFC in January 2010. This is in our subscription business, and the share price was $31. And at the time, it only yielded 2.2%. So not necessarily a stock you'd think would be in a dividend fund. Now, the capital gains since then, and this actually includes a more recent period where the stock has gone nowhere for 5 years, the capital gains have been 18% per annum. The growth in the dividend has been 12% per annum. And today's yield on that original recommendation price is 12%. So that does look more like a dividend stock. Now, the more typical stock that usually is the headline of any great Australian dividend portfolio is Company B, and its share price at the same time back in 2010 was $56, and the yield was 5.2%. So that's more your typical dividend sounding stock. Now, the capital gains since then have only been 6.3%, and I would also argue they're overcooked and are going to go down for reasons I'll explain in a minute. The dividend growth has only been 2.1%, so nothing like the 12% per annum from Company A. And the yield today on that original price back in 2010 is 8%. So, a good third under what Company A is doing. So which company would you prefer to own? Obviously, it's Company A. All right. Yes, your yield started out quite low, but because of the growth in the profits over time, you ended up with a far, far, far better result. So what is Company A and what's Company B? Well, Company A is CSL and Company B is CBA. And you could pick lots of different examples, and you could say, okay, you've picked one of the best companies ever. But there's a whole bunch of different companies you could have used for CSL, and you could have substituted a whole bunch of other companies too that have done much worse than Commonwealth Bank. And I'd argue Commonwealth Bank is overvalued at the moment. Its price looks absolutely insane to me. I don't think it's ever traded at 23 or 24 times earnings multiple for, and its earnings are going backwards. And if interest rates start going down next year, then its earnings will get hit again. So it just makes absolutely no sense. So I feel like our Company B example is actually pretty fair, because we could have easily picked one of the other banks and those numbers would look absolutely awful. And for
I was going
CSL,
to say just quickly, Nathan, there was a question that we received in the registration from Sydney just saying, is CBA at least worth holding for the dividend?
So that's a great question. I'm going to talk very briefly. I'll show you a chart on the banks in a minute, but we can have the discussion now. Is Commonwealth Bank at the moment is trading on around a 3.5% fully franked dividend yield, but it's trading on a multiple of about 23 or 24 times earnings, which is just ridiculous. I think it's trading at 3 times book value when its return on equity is declining. So none of this makes sense on a fundamental rationality. It's only trading at that because ETFs are currently dominating the market. And I'll talk about again this in a second. And it's just the more money that comes into the market, it just has to go into the biggest stocks. And Commonwealth is one of the biggest stocks, and so that's where the money's going. So it's got nothing to do with the value of the stock. But I would ask you the question: do you want to, like, the banks have been pretty awful investments really for the last 10, 20 years. Like, they really haven't produced any capital gains at all, except for Commonwealth Bank. And even they've been pretty mediocre. So the question is, I would say, if the best you could do over the next 10 years with CBA is to earn the 3.5% fully franked dividend yield and actually not lose any money from the current share price, would you still want to hang on? Or alternatively, if the multiple goes back to, say, 2 times book value, and so the share price falls by a third, and then you get, so you've got to sort of factor in those losses, those capital losses into the dividend return you get over the next 10 years. Like, would you still want to own it? And the answer for me is an obvious no. But I get why a lot of individuals feel like they're stuck, because a lot of people have owned this since the early 90s and they've got these huge capital gains and they don't want to have to pay the capital gains bill. But this is a highly, highly unusual situation for bank valuations and CBA in particular. And that's actually what drove the title of this presentation when I said this is the time to be contrarian. Like, it really hasn't paid to be contrarian over the last 10 or 15 years. You just wanted to buy the fastest growing, most popular, biggest stocks, and it's worked out absolutely tremendously. And if you've sort of been more focused on valuations, you've just been fighting a tidal wave. But to me, at some point, I don't know when the market's attitude is going to change. But at some price, these bubbly valuations we're seeing in CBA and plenty of other of the big stocks, the market's going to move on. But just let me get to the next couple of slides, and I'll talk about that a little bit more. I wanted to talk about the distributions because there's a couple of things I really want to highlight here. I haven't had this slide in before because normally the distribution just takes care of itself, and there's not too much to explain. But I've noticed we've had a few questions from people over the last couple of years about why is the current distribution so low, and I wanted to also explain a couple of other features of actually what drives the distribution, because really this is what the income fund is all about, is the distributions, but it's quite nuanced and there's actually a lot going on. So I thought I'd just take a couple of minutes to explain the history here, because it looks quite volatile and some of the numbers actually look quite low, but there's good reasoning for that. So the first thing I just want to point out is these annual distributions have also got the management fee taken out of them. So they do look at just basically 1% you've got to add to them to actually get the underlying yield of the fund. And the way we've historically run the fund is that we try to have the yield above the yield that the index or the market offers, and that way you don't really notice the management fee coming out each year. But these numbers have the 1%, 0.97% annual management fee out of them. So if you want to actually get to the underlying yield from the fund that's actually coming from dividends from the stocks that the fund owns, you've just got to add 1% to those green bars. Now, there's three things that stand out here. There's the low yield in 21. So remember, the actual dividends coming out of the fund are actually 2%, but it's got the management fee out of it. And then more recently in 24. So I want to talk about those. And I also want to talk about the way capital gains are distributed in the fund too, because it's really important, and I don't think everybody understands that. So 19 and 20 were typical years, and then 21 had this much lower income return year. And the reason for that was COVID. And that was because a lot of companies were cutting their dividends temporarily. And so we were buying a lot of those and we owned a lot of those. And the basis for that was we thought, in a year's or two's time, when the dividends went back to where they were normally, then we'd have these huge capital gains. And actually what happened is we didn't actually have to wait. We had takeovers for our two biggest positions, which were, like 10 or 11% of the fund together, maybe more. At the time, actually, I think Sydney Airport might have been 7% of the fund at the time. And so we didn't actually get a chance to hang on to them for the yield to come back. They got taken off us, but on the flip side, we got these huge premiums for these businesses in capital gains, and funds like ours and basically all income funds have to distribute all their capital gains annually. So we might have capital losses that build up and then they offset those capital gains. But if we've got capital gains at the end of the financial year, we have to pay those out. So they're the big orange bars. So normally what we have is we have a period where for 2 or 3 years we have this great performance and we have big capital gains, and we might have some takeovers, or we might sell some stocks because they get fully valued, and then you get these monster distributions. So you can see that basically the sacrifice of a little bit of yield in 21 was worth it, 8 times over for the capital gains that we distributed the year after. Now, they might have slightly different tax consequences for people, but clearly as an investment decision, it was the right thing to do. And you can see there in 22 and 23, the yield of the fund just coming from the dividends went back to normal. Now, the other aberration is 24, where the yield on the fund is actually about 3%, which is about, I think the yield on the market at the moment is 3.5, so slightly under. But this was deliberate on our part because we wanted to buy RPM Global, which is a small software stock. And up until recently, that stock had added about 3 or 4, if not more, % to the total annual returns of the fund. But it doesn't pay dividends. It's buying back shares with its cash pile instead of paying dividends, because it hasn't got a franking bank yet. And we expected that to happen next year. So that we thought that was worth a sort of 0.5% loss in the yield to get that huge capital gain that we've got. And we still think it's going to be taken over at a much higher price than it's currently trading at. But the other thing was, because initially it was a small business, we had to hold a cash against it because of those small cap liquidity constraints that govern the fund by the ASX liquidity rules. So long story short, it was an excellent decision for the fund. It's been a huge winner. but we did have to sacrifice about 0.5% of the normal yield. But we think it was definitely a result for the fund. So I wish the return profile was a little bit more consistent. I wish we could just have 8% every year, but that's not how it works. And just further to the 24 period, this year would have actually been, this year coming would have actually been a big year for those capital gain distributions. But because we had a couple of mistakes a couple of years ago, including Star Entertainment, which was the main one, which I was going to talk about coming up, but that's the most frustrating one because it was a large position and we had a chance to get out of it and we didn't take it, and it turned out to be a much worse situation than we anticipated. So we've actually used the capital gains from some recent sales to offset those losses we had building. So this year may end up having some of that capital gain distributions, but it remains to be seen. So I hope that's actually clear about the distributions, but I guess all you need to know right now is that the yield of the fund is right in line, bang in line with the index at 3.5%. But we'll try and get that up to 4.5% over the course of the year, because I much prefer it when the management fee is covered in the distribution. But it's not the most important thing. The most important thing is that we have a consistent, durable yield that people can bank each year. But in order to outperform, sometimes we have to make these compromises. And you can see those huge years in the capital return bars that it's by far and away worth it. It's more than worth it to give up a little bit of yield just for 12 months if you're going to get returns like that. So to finish off this discussion, let's look at the performance, and it actually looks like it's been a fairly smooth ride there, and it's been anything but. When I first got back, so let's go back. I left the business in early 2015, just before we launched these funds. And one of the key things I left the fund, one of the ways I left it positioned was very short the banks. And that proved a very good piece of outperformance for the next year or two. So that's where that outperformance came from. And then, unfortunately, I came back and it wasn't the present sort of wasn't reciprocated, and I inherited a basket case of a portfolio that a few months after I turned in late 18, in early 2019, the portfolio just stuck there dead. And I think even one stock that was in there might have ended up even going broke. And the market just took off. So within about 4 or 5 months of me coming back after doing international stocks for 3 years, we suddenly found the fund, which had just been listed as an ETF fairly recently, was 26% under the market. And I always use this opportunity to thank everyone who stuck with us through that period, because it would have been really easy just to give up and go to another fund. But basically, I just rolled up my sleeves, got a whole lot of better stocks in there, finally got across the Aussie market over the next sort of 6-9 months. And then we made a lot of other changes to the business as well, not just the fund or the stock holdings, but the actual business. We rejoined the subscription business with the funds business. So then I became research director again. And that worked out really well from then on. And we're also perfectly positioned when the COVID bear market came. So, stocks I added like Lavisa and Pinnacle and a whole bunch of these other ones, Macquarie Technology, I think might have been in there as another one. There's a whole bunch of these stocks that just absolutely went bonkers through that COVID bull market. So I think from that bottom period with that 26% deficit, I think we then outperformed the market over the next 3 years by 36%. So it was an absolutely incredible period. And you can see that in the chart, in the orange chart, sort of going there from 19 up until 22. And the icing on the cake was when the market came off a bit in 21, when interest rates started going up, 22, Gorav's coal picks were just added another whole layer of returns to the fund. And since then, it's been much tougher going. And that's always the way with a value fund like ours. We buy all these undervalued stocks, and then they sort of have this great run, and we have all this outperformance, and then we sort of go back to the sowing part rather than the reaping part. And we've been in that sowing part more recently. And I'm going to talk about a few of the stocks that explain why we've been underperforming lately. But, again, it's going to be very easy to get back to the 2% when the market changes its attitude, as long as we've got the right stocks. And that's what you need to judge us on from this webinar. I won't go, so that's sort of a good explanation of the performance. I've talked about the iron ore miners. I've talked about the banks potentially being in a bubble. I certainly think CBA is in a bubble. Even the other banks are probably only offering 5-6% max annual returns from here. And I'd say the market's at fair value when you can get a 9 or 10% return, which is consistent with the long-term returns of the market. So, banks would need to fall as a group probably 30% to, get back to 7 or 8% returns for the group. So, I don't know what your definition of a bubble is, but that's why we don't own any banks, but it's killed us lately. Look at this slide. Like, this is absolutely insanity. Like, the banks have never been bigger. The return on equity has never been lower, and their valuations have never been higher. Like, it makes absolutely no sense. And I'm going to talk about a few stocks in a moment, but the banks have contributed about 9% or more of the market's return over the last 14 months. So I fully expect we're going to get that back at some point. So there's a couple of stocks we own. I'll do this exercise now while we're here. But one of the stocks I'm going to talk about, if that just went back to the price it was 4 months ago, and the other stock doubled and just went back to $8, it's trading at around $4.30 currently, which is not even back to the highs of it was in 21. If just those two stocks did that, and the banks went back to where they were, just remotely towards near fair value, not even back to fair value, just that situation alone would add about 16% of our performance to the fund. So that shows you why our returns are lumpy and why you get those big capital distributions over a couple of years, and then you go back to just getting the yield, and then you get the capital gains again. So it's this constantly reaping and sowing process that we go through at the moment, and it's clearly obvious to us where the value is at the moment. But it doesn't matter whether the market's in a bubble or the banks are in a bubble or Goodman Group's in a bubble, or at the moment, it doesn't matter. It's just that the big money is going into the ETFs, and they have to go into the bigger stocks. So it's pushing those particular stocks up to what I think are irrational values, and it's leaving all this value behind. So at some point, it's going to flip, and the money will start paying more attention to where the value is. But as always, I just don't know what the timing is. But it's frustrating because the value in our stocks, as a group, like, you never know which stocks are going to do the best. But it's the old Peter Lynch quote. He says, I'll give you a portfolio of 5 stocks, and I know those 5 stocks are going to do great as a group. I just don't know which ones are going to do great, which ones will do mediocre, and which 1 or 2 will perform poorly. Is there anything you want to? I know I've just talked quite a tirade there. Tom, is there anything you want to say? Oh, okay.
Sorry, there's some.
There you go.
Yeah, sorry. Some really good questions coming through. Some talking about the distributions, which you've run through as well, explaining, the predicament and the situation with that. So thanks very much for asking those. I know you're going to talk about the banks coming up a bit more, but there was questions about Macquarie Bank. Questions even interesting ones like, will Intelligent Investor Income Fund be participating in the class action against Star Casino as well? There's some really good questions.
Yeah, no, we haven't done that. I haven't seen any reason to do that. I think the fact is we made a mistake. The CEO didn't outright lie, but he certainly wasn't upfront after that first capital raising about how dire the company's financial situation was. But I'm more angry at myself because I was worried about it, and I had a discussion with our analyst at the time. And it's my job to override the analyst and make the hard decision when we need to. And neither of us didn't think that the company would need anywhere near the money it would need in the raise. So sort of thought, okay, well, let's just hang on and it won't be that bad. And it turned out to be horrendous. But I had the opportunity to pull the plug and I didn't. So that was just my mistake, and I should have overrode the call there. So that's my fault. And we've certainly had a lot of team discussions since then to make sure we don't have one like that again. It's not that you're not going to make mistakes, but you want to make good mistakes. And that was just a bad one. And that's really the only bad one we've had since I've been back to the business. So it was, it still hurts. Like, you don't want to get in the way of the compounding. And, we're very focused and we don't generally make big mistakes like that. When I say it was big too, it wasn't sort of anything we couldn't come back from, but it was just frustrating to me because it's, when you're running an income fund, every percent counts. And that was just one where, we lost a few percent, which was in the end was unnecessary and should have trusted my gut. So, I have to wear that one. And as you can see, it still pains me. As for Macquarie, we put a sell on that recently in the subscription business. So I don't think there's any value there. There's a lot of just the bigger stocks in general, are just trading at such big valuations. But it's but on the flip side, we're seeing all these small cap managers now leaving the industry. Like the flows aren't there. People are taking the money out. The returns from small caps and micro caps after the since 21 have been horrendous. So the money's just like leaving one area and going to another. So when you see that happening, and it's just so one way, there's going to be value left elsewhere. But it's frustrating because the value is obvious. Like if our portfolio overall traded at the valuations that the top 20 stocks trade at the moment, then the fund would probably put on 30 or 40% instantly. Now, I'm not saying all those stocks deserve to trade at those valuations, but it's just so obvious when, like, I wasn't going to talk about Aussie Broadband today, but this little business is trading on 7 times EBITDA. Unity, which was one of our biggest positions, got taken over 3 years ago, got taken out at multiples of that. And we expect the same thing will happen here, but the fact is the earnings aren't growing rapidly at the moment, and it's small, relatively small. So it's just not getting the flows, and we're seeing more active managers leave the market at the moment. So you can see what's happening, but you just got to hang in there because the returns are coming. It's just a matter of when. So that's why I included this slide, because it really sums things up. Because what is they always say history rhymes, and I think we're in that situation currently. It's not like I'm expecting another GFC or anything like that. I think it's just an overvaluation situation, egged on by ETFs, which just don't care about value, but that's where the money's being invested because everyone wants to be passively investing because that's what's done the best over the last 10, 15 years. But that's what the market does better than anything else. It takes things to extremes. So what was sensible 10 or 15 years ago is absolutely irrational on a fundamental basis today. And that's really how our fund is structured. So I just wanted to give you, for anyone who's a little bit frustrated, whether it's their individual stocks not performing or maybe they're just not keeping up or whatever, don't worry about it. I'm as frustrated as anyone, but this is part of life. But these stats will hopefully give you a little bit of hope. So I'll just read these ad verbatim. Top 5 combined market cap. Sorry, this is the US market, but it rhymes with the Australian market situation. So the top 5 combined market cap stocks in the US is now 3.3 times the size of the entire Russell 2000 index. So the Russell 2000 has the smallest cap stocks in it. That is more than 2 times the level in the 1999-2000 time period. So that was the tech boom. So let that settle for a minute. Like, it's just outrageous. Now, the second part is, so after that, from 2000 and 2006, small cap value had annualized returns of 16% per annum, while the S&P 500 was closer to 1%. 1%. And longer duration equities generated negative annualized returns. All right, so that's what happens when the boat really just, all goes one way. Everybody's sitting up one end at the moment, and at some point, something's going to change the market's attitude, and I don't know when it is. I don't know if it's next month or next year, but then everyone on one side of the boat will run across to the other side of the boat, and that's what we're positioned for. But because we can't time these things, we need to own these stocks now and just sit and be patient. But that's really sums up the current market situation. I remember when everyone used to talk about Microsoft, buying Microsoft in 99, and it took 12, 14 years or something to get your money back. And now no one talks about that anymore because the stock's done so well over the last 7 or 8 years. It's all about how good has Microsoft done. But Microsoft was a killer for like over a decade and was the number one stock you used by value investors to make that example about overpaying for quality. So just to show you where we are, this is a chart. You don't really need to know the detail here, but it just compares the valuations of large cap stocks to mid and small caps. And so we're basically at a 24-year low at the moment. So there's got to be some value in the smaller cap stuff. And for anyone who's actually interested in trying to capitalize on that small cap valuation discrepancy, in my personal view, just buying a small cap index fund isn't the way to go because it includes all these resources minnows that end up being worth zero. And the small cap index is actually the easiest one that I know of to beat because it's just so full of resources stocks, speculative stocks that end up being worth zero. So you're actually better off trying to pick the eyes out of the small cap, which is what we do. We just own, sort of half a dozen of those smaller mid cap stocks. They're actually high quality, high cash flow, paying dividends and all the rest. They're actually well-established businesses, not, speculative mining stocks that are essentially lottery tickets. But also, even if you just wanted to buy a small cap manager, I still think that's a better way of doing it because, again, they'll pick the eyeballs out of it. But normally, just buying an index fund can make sense for certain things, but I just don't think it makes sense for to play that small cap game. In saying that too, I wouldn't say all small cap stocks are cheap, by the way, either. Look at what Ordinate's done recently. So we didn't have it in this fund, but it's been a key call for us in the other funds, and we made a lot of money out of it because it went up fourfold. And fortunately, I sold it, and I've never been happier. We actually kept a tiny holding in the fund, just basically for our ego, I think, just to say we could own it for all its life if it ended up going to $40 in some sort of crazy situation, but it didn't. It's pulled right back. So this is the ETF dominance. I don't know if I've got my facts exactly right here, but I think I'm right in saying that a few months ago, ETFs finally took over in terms of sheer dollars, the total dollars invested in active management strategy. So that's a monumental change for markets, and it does have impacts. When you take active managers out of the market, it means stocks just aren't getting discovered on what their future earnings are going to be necessarily. So, for example, what I'd say is in the past, if you owned a stock and you could see in 12 or 18 months that the earnings were going to go through an inflection point and increase, then the market would already start ascribing the value to those stocks. So essentially, you'd get rewarded as sort of a year before the actual financial statements showed the higher earnings. Now, what you're seeing is because this is all algorithm driven. It's not just ETFs, it's just algorithms generally that are looking for certain things, whether it's earnings growth or revenue growth or dividend increases or whatever. They need the actual information to be reported for their algorithms to pick it up. So you're not getting rewarded in advance anymore. So it's still, the key is to still find those rocket ships while they're still docked and then wait for the market to discover them and, then enjoy the ride afterwards. That's what we're trying to do. But it is frustrating having to wait longer now for the earnings to actually show up before you get the reward. So these are real changes in the way markets are working, and we're certainly not oblivious to it, but it doesn't really change the way you invest. The idea at the end of the day is to buy undervalued stocks, and eventually the market will pick them up. I just wanted to highlight this. This is another one just to give people a little bit of enthusiasm if they've been buying smaller cap stocks or other stocks that haven't panned out yet and get left out, even though you think they don't deserve it. And this was, I just want to highlight, again, this is a similar chart to the one I just showed about the comparison of valuations between large and small caps. And you can see last November, I actually did this webinar for the Ethical Fund, and I felt like I was actually apologising for the performance of the fund because I hadn't really been doing anything. And little did I know, like literally as I was talking, it was the start of a sort of 2 or 3 month run in small cap stocks because people thought interest rates were going to fall. And then so then you sort of really saw that a lot of those smaller cap stocks bounce, pretty hard. Some of them like doubled or more. And then all of a sudden, I think it was the March inflation print came out. And then it was like, oh no, interest rates are going to have to go up again. Like we haven't killed inflation. And all that enthusiasm just disappeared. And so all those small cap stocks just fell back down again. So you can see it's not a valuation thing. It's more of a what are people feeling thing. It's an attitude thing. And when the market's attitude changes, you've got to already be in those stocks to enjoy those gains, because if you miss the first 20 or 30% gain, then that's the difference between doubling your money over the next couple of years or making 50%. And for us, to do that on a few stocks, like that makes an enormous difference to your funds, to your portfolio. So we need to be positioned now. We can't try and time these things. It's impossible. So I'm going to run through some stocks. I realize I'm taking up more time than I actually wanted to, but I thought they were really important things I need to talk about today. So I'm just going to race through these stocks. Pinnacle is one we've just sold. That would have produced a nice capital gain payout or distribution for us, but because it's basically offset the star loss for us. So, but this was the perfect dividend stock for us. This was a stock that I introduced, probably just about the first stock I introduced back into the fund when I came back to the business in 2018. I think I started buying it. It might have been 3, it might have been some at 5, and then it fell to $2.50 in the COVID bear market when I think we bought a few more. Then the stock went to $20, and the dividends per year went up 50% a year for 4 or 5 years. So we actually we didn't sell it all at $20. I wish we did, but we had so much cash and like we had to hang on to something, and that's part of the reason why the fund has underperformed. In 22 was because we actually should have sold more stocks at the peak, but it would have left us with, like, if we had sold everything, I felt like should have been sold, we would have had 50% cash in the fund, and obviously that smashes the yield of the fund, and obviously no one's going to invest in the fund with 50% cash. But so we thought we kept the best of what there was. but it has hurt. Anyway, the stock's got back to around $17 and we've just sold it again. So, but the reason why it's the perfect stock was because we had these huge capital gains. Some of the capital gains were 7-fold returns. And then more importantly was the dividends. Like, look how fast the dividends have gone up. I apologize for the lack of labeling on my charts, but the right-hand side is the share price, and the share price is the orange line. And I've just put a price at the middle of the year, so it's not a perfectly accurate representation, but it's pretty close. But you can see basically the share price went from about $5 in 2018. I went up to 19. You don't actually see that in the chart because I've just picked an annual number, but it actually went up to $19.60 or something, fell all the way back down to around 7, and then it's bounced back up to 17 where we are now. So we've had huge capital gains, but most importantly, because the earnings have been growing so fast, the dividends have been growing rapidly. So that was our perfect stock, and we thank Ian McCoon, the CEO and founder of Pinnacle, for such an excellent result. So MA Financial is really what I'm hoping can be the next Pinnacle. I won't go into too much detail because otherwise we won't have time for Q&A, but this is a business that's just released its results this morning. I'm not sure how the market would take it, but the fall in the earnings was predictable, and it's because they're investing, not because they're sort of losing money or the earnings have fallen. But I think this business, although it hasn't said it specifically, I think this is a business that's aiming to earn 40 or 45 cents in earnings per share by 2026. And I don't see any reason other than the complete catastrophe in the economy or markets of why it wouldn't do that. And that would put it on a price to earnings ratio of 10. It's currently yielding around 5%, just under now. So you're getting paid to wait. But if the earnings go up, from around the underlying earnings are about 30 cents at the moment. So it's only trading on about 14 times earnings now. But if it gets a 20 times multiple, then you're at $9 a share, which is double what it is currently. And it ticks all the boxes of what we're looking for in a business. It doesn't guarantee anything, but thanks for that, Michael. I'm glad the share price is up because it makes no sense where it's trading at the moment. It should be trading at least $6 in my view. Underlying is earnings 30 cents, and given the ridiculous valuations of some of the big stocks at the moment, like if CBA is trading at 24 times earnings, then MAF should be trading at 30 times any day of the week. The risks are obviously higher as a smaller business, but in terms of the growth and all the rest of it, that's my view. So that's MAF, and you see this nice chart here. That's the dividends per share. So Pinnacle and MAF are just two absolute perfect examples of what we're looking for in this fund. All right, there might be a bit of volatility around the capital gains, but those dividends grow rapidly, and you can see how rapidly the dividends have grown in this business. And again, the reason the dividends are so strong from these two particular businesses is because they're founder-owned. The biggest shareholders in the business are the people running it, and they don't want to get they want the capital gains, but they also want they know what the best thing is to do with the profits from the business, and they can't find good things to invest in, then they want the fully franked dividends to be going in their own bank accounts. So those two stocks are really perfect examples of what we're looking for. Eagers Automotive, its results were also out this morning, and I actually thought they were going to be worse. So I'm not sure if anyone's watching the market, maybe can tell me what it's done. But again, I won't go into a lot of detail here, but obviously the economy is slowing a bit and people are being very worried about just the number of cars being sold, but also the pricing, because you tend to get discounts on cars, particularly in downturns. But again, huge insider ownership in this stock. Really got under the radar, and only we've, thanks to Goro, have only really picked up on it recently. But again, it's trading on 10 times earnings. You're getting paid to wait. This is probably a business that's never going to trade on a high price to earnings ratio anyway, but certainly deserving of one of 15 at least. But you're getting a 70% fully franked annual dividend at the moment. So you're nearly getting your 10% annual return that we're aiming for in dividends alone. And again, insider owner, I think hasn't missed a dividend since it listed in 1957, and I think it's the only stock on the ASX that's done that. It has very high return on equity, much higher than you expect, but it looks like it's got this huge amount of debt, and it looks like it's a real financial risk. But when you understand a lot of that debt and the way it's works with the way the floor stock is with the cars and how they're sold, it's actually not what I'll consider real debt in that sense. So thanks, Michael. So it's down 5% this morning. I actually didn't think the result was too bad. I think it could have been a lot worse. But again, it captures all the things we're looking for. It's out of favour, big fully franked dividend yield because it kept the dividend stable this morning from what I saw. Looks cheap, but the market's just fearful of a recession, so it's sold the stock down. So that's our opportunity. I've gone through MinRes before. I'll just breeze on it very quickly because this is one of our biggest positions, and the stock's been absolutely killed recently. Well, I think we bought it around $65 and looked like a hero for a minute there, and I think it went to 97, come back down to 52 on the lithium price fall. Probably should have sold it at 97, but we really believe this was a $120 stock and $150 stock if it's gas, if it's allowed to export the gas it's found. So we hung on to it. Then we wrote it down to 52. I can't remember if we bought any more then, but then it went back up to 79. We thought, okay, the lithium sort of passing through, and then lithium's got worse, and now iron ore share price is falling. Iron ore prices are falling, and now everyone's just heap scoring on Mineral Resource, and it's gone all the way down to, I think it was $43 a day or two ago. And then yesterday, I think there was a rumor about Rio acquiring it, which it certainly wouldn't happen at this anywhere near this price. I wouldn't have thought. And the stock went up a little bit yesterday to $46. So. But this is I wish I had another slide in here, which just shows you the growth in output that's expected from this business over the next few years across all of its businesses. And we still believe this is potentially a $100 plus stock, if not much more. So it's a stock we're sticking with. It's a stock or a business that was founded by Chris Ellison, who basically started it with a credit card. It's been an incredible business. It's very underappreciated, but at the moment you've got falling resources prices, and it's got a lot of debt because it's just built a lot of those businesses. But they are great businesses it's built. Just the timing is just not ideal, but obviously it's better that they're actually built and earning money than they're halfway built. But the most underappreciated part of the business is it's iron ore crushing business. So it basically gets all this iron ore for all the other big iron ore companies in Western Australia, and it does all the crushing. And it's an extraordinary business with some of the contracts are for life of mine for 50 or 70 years. So it's not correlated to the price of iron ore. It's just a volume business. All it does is crush the iron ore and move it on. So it's an extraordinary business, and that's what really underpins the business. So, my guess is that's probably worth $45 alone. You're getting everything else for free. So we just got to get through this tough little period. But if we hadn't have already swung pretty hard with the stock as we've been buying, it's been falling, we'd be buying more today. But, it's unfortunate because, if Mineral Resources just went back to $80, that's not even what we think fair value is, but that's where it was trading a few months ago. If this went back to $80, if MAF went to $8 or $9, and the banks went back to where they were 15 months ago, which I think is the least they deserve, there's 16 or 17% of our performance in the fund just from that situation alone. So you can see why our returns are lumpy, but we've just got to sit here and wait. But you can have two things. You need to have great performance, or you can have cheap stocks. You can't have both. So at the moment we've got cheap stocks, and there's just to see what's happened to lithium. It's gone even down further since that chart, but we won't hang there. I've taken up enough time. Just the one other thing I'd say is people ask about the comparison between the income fund and the other two funds, IIG, our growth fund, and our ethical fund, and they are quite different. The way I try to, my starting point with the funds is I actually want them to be everything. I want them to have high growth, big dividend yields, and I want them to be ethical. And then you start making from there. So, absolutely, one of the stocks that's killed me personally from not having it there, because I knew it better than anyone, and we had a chance to buy it at $10 a few years ago and we didn't take it, is Goodman Group. I followed that thing since I started Intelligent Investor in 2006. And I doubt if there's anyone in the market that knows that business, has covered that business for that long as what I have. And I never put a buy on it. And at $10, we should have. But that would have been the perfect stock for all of our funds. You could have put 5 or 6% in it, owner managed, great business, pays a good yield, good growth, and it's ethical. So, so that's how we sort of make the compromises after that. So yes, there is some overlap, and I actually want there to be overlap because I want stocks that deliver all those things, but obviously you can't do that. So they are quite different, but it does make it can make sense to diversify between them depending on what your goals are. But the dividend for the other funds is nowhere near what it's going to be for the income fund. In terms of the franking, we certainly pass the franking on with our stocks, but not necessarily all of the stocks pay franked dividends. There are some that don't. Auckland Airport is one, but I think it does actually have a supplemental dividend or distribution for Australian investors. But we certainly passed the franking on. But if you're trying to maximise franking credits, I wouldn't say this is the fund for you. This is really a genuine fund that's designed to outperform the market over time, and for that reason, sometimes we make compromises on the franking.
I was going to say, Nathan, I'll give you a bit of a break just to get your voice back. There's a question coming through. Joy was just saying, what's the differences between subscribing to the INIF fund through this offer or buying it on the stock exchange? So I covered it briefly at the start. You can do both. You can actually purchase it just like a share. It trades on the ASX under the ticker code INIF. Going through the offer, you don't pay brokerage. You go straight through Intelligent Investor. You don't pay the buy-sell spread. You get the net asset value in the middle, which is determined at the close on Friday, the 30th of August, which is the closing time, 5 p.m. for this particular offer. So great question. We got a lot of questions coming through. Did you want me to start?
By the way, Tom, I don't mind if we stay on for an extra 5 or 10 minutes and get through more of them, because I know I've taken up more time than I meant to.
Yeah, sure. There's some really good questions too. There was questions also just being asked about, what's in the fund? Do we have this? And luckily, one of our team members, Mitchell Datson, so you might have spoken to him. He's answering some of them, just saying that, we do publish the month-end holdings to the ASX. So if you go to ASX website, the announcements area, you can actually see, in that case, KAR was not in the fund, which was a question from Michael.
I think KAR, for people, that's Karoon Energy, and it's just had a big win. Shareholders just had a big win with the changing incentives for management, and now it looks like there's going to be a massive stream of distribution dividends coming out of that stock. So that's why it wasn't in there in the past. It looks incredibly cheap. I think that's one where, in the ultra bull case, we could potentially make 4 times our money if everything goes well. But if we don't, it's fine. It's still worth way more. I think it's trading on, if I've got Gorav's numbers right, a 25% free cash flow yield at the moment, which is just insane. This is what gets me about the current market, right? You've got stocks like Karoon trading on a 25% free cash flow yield, and you've got CBA trading on a 3.5% free cash flow yield, and its earnings are going backwards. It's crazy.
Sarah's asking there, what stock do you feel the same way about today as you did in with Goodman back in 2006?
So if the interpretation of that is, does that mean like a stock that I wish I had bought? Believe me, Sarah, the mistakes of omission are the ones that kill you. They really are. Just sitting there watching the stock go up and up and up, and you didn't buy it. It's much easier to buy a small amount of a stock at the start, and if you're not quite sure about it, and then decide whether you want to add to it later on or whether you have to sell it because it's become a huge position, than it is when the stock's gone up threefold or more and you're asking yourself, should I still buy it? And that's what I really try to do. But in terms of missed opportunities, maybe not necessarily for the income fund, but WiseTech's been a bit of a killer. That's been a terrific stock. In our history, we've actually been really good at picking up a lot of the growth stocks early. I'd say the thing that's been an error, particularly earlier on, was we were just no good at hanging on to them. We're just too much activity, just not enough holding. Even back, CSL is one I just wish I'd bought myself. Like if you go back to 2009 or 10 and look at some of my ridiculous calls in the newsletter, putting a hold on REA Group at $4.50. I mean, that's just a killer. It was on 10 times earnings. Like it was just, I was still pretty green then, but that's no excuse. Upgraded CSL. Fish and Paykel Healthcare has done far better. We sold that at $3.50 after doing the hard work, buying it just after the GFC when it was under a lot of pressure, and just didn't hang on to it. Aristocrat we didn't hang on to. We sold in the subscription business at $7. Like just really we've really learned the lesson the hard way about just hanging on to those great businesses. If the valuation looks a bit stretched, just ignore it, just hang on. But I'd say something like Commonwealth Bank, where the range of outcomes are much more narrower than they are for something like a tech stock like WiseTech, that you can be much more confident about. Commonwealth Bank is not going to come out and all of a sudden produce 15, 20% earnings growth for the next decade. That is not happening. But obviously you saw WiseTech's result yesterday. It was enormous. And we had a second opportunity when the short report came out, I think in 2019 or 20 maybe, and the stock might have went to $20 or $30 or something. That was a real opportunity looking back. So there are always these mistakes of omission, Sarah, but that's why I don't worry about losing money most of the time, because we tend to make good mistakes most of the time, even though Star wasn't one of those. But those missing those great businesses, they kill you.
There's another question here. It's actually two. I can roll into one, and it may not even be in your area that you manage, but it has to do with the way that dividends are treated. I'll put the two questions up, and then I'll tell you what I'm trying to talk about at the end. So Mark's just asking that if all the companies are earning 5% plus, then why aren't we getting that from INIF? And then Ritu was just saying, do you reinvest any part of the dividend or just pass all of it to the investors? And what I was going to do to wrap it up is, in terms of these two questions, it's not like you have the ability to sometimes wait with some of the distributions. Like, you can wait until they're a larger amount and then pay them out. Is that correct? Is that something that you look after? Is it more of like the management of the fund itself?
Yeah, all that's done by our team in the background, in the back office. But you can do a little bit of that. But basically, at the end of the year, all those dividends have to be paid out. So we can't hang on to any of that stuff. And same with those capital gains. In response to the first question, why isn't, if all these stocks are yielding 5%, why isn't the fund yielding 5%? Well, not all the stocks are yielding 5%. The yield on the index or the market at the moment is only 3.5%. All right, that's because valuations are so high. So that's all you're getting is 3.5. So the way we try to manage the fund normally is we try to run with 4.5% in that situation, because we just want the management fee just to come out. So you're still getting the same yield as the index, but you're getting much higher capital gains over time. But in saying that, you get those capital gains as distributions as well. They're not just reinvested. So if you actually want the money to be compounding, you need to have your dividend reinvestment plan reinvesting that money. So that's really a personal decision. But at the moment,
I was just going.
Sorry, Tom, you go.
I was just going to say, just for people who don't actually understand this, is if you go to the share registry, which is a link we've put up before called Link Market Services, you can actually turn that dividend reinvestment on. So it reinvests any income paid out to you back into the ETF, and you don't pay brokerage. So that's something that a lot of people sometimes get the dividend paid to the bank, the bank account they've got, but you can turn that on, and it's something that, like Nathan just mentioned, definitely helps that compounding return over time.
The thing is, like, if we put together a portfolio today and it yielded 5%, then you might be happy because you're getting a little bit extra each year, but you're giving up your opportunity to outperform. Then, like, you're not going to outperform. So that's really what I would call maximizing the current distribution yield, which is what we don't want to do. You can't outperform doing that. As I said, the market's only yielding 3.5%. Like, even BHP at the moment is only yielding around 5%. All right, and that's one of the biggest dividend, highest yielding stocks on the market. So don't kid yourself. Like, it's actually pretty hard to find undervalued stocks in this environment. And I love the way the portfolio looks at the moment. There's probably a couple that are stocks that are a bit expensive, like Wesfarmers. But if the lithium business comes through or recovers eventually, then that'll be fine. But returns, I don't know what people's expectations are for returns from the top 20 stocks at the moment, but really the capital gains is virtually zero. In fact, there's one broker I follow that has a good model for what the expected returns are of the market. And so remember, the market is really just the iron ore miners, the banks, the four big banks, and the AREITs, and CSL. I think that's 85% of the index of the market. So at the moment, they're saying that the annual return you'll get from that portfolio at the moment is 3.5%, which is the dividend yield. They think at these valuations there is no capital gains to be had. All right, so that's just, I'm trying to explain, really just how many people are sitting on that one end of the boat at the moment. And interestingly, it's actually not individuals. Like with the banks, for example, Australian investors have actually been selling the banks. It's not like this is dumb money in that sense, because I actually think it's quite sensible for all these investors to be moving on from the banks at these valuations. What it actually is there's just a lot of other investors So Asian investors see Australia as a safety harbour. So they've been buying up the banks. They don't mind. They're happy to get the 3.5% dividend yield for a short period, and maybe the Aussie dollar stays strong or goes up versus the US dollar, because our interest rates are probably going to be the last to go down. So they earn a little bit on the currency as well, and they're happy with that. ETFs, they don't care about value, so they're just going into the biggest stocks. But actually, it's interesting that the individuals are actually seeing this, looking at the valuations and going, there are better stocks to be in. So that's really encouraging.
There's just a question there from Pete too, just saying, if banks retrace to a reasonable price, won't there be a massive knock-on effect to the rest of the market?
Yeah, look, I don't know. Maybe, I don't know whether it's one stock at a time or it takes a market event to knock them all down, or is it just CBA goes down and maybe the other banks don't go down as much, or I have no idea. But to me, that's just a timing issue, and I think it's pretty obvious. With the stocks that I've talked about, that if they got cheaper, then we'll just buy more. That'd be great. But the stocks are cheap. That's all we focus on. We're not market timers.
There's another question here too. I'll just find it. And we were talking about, I guess, the US. There's so much happening over there at the moment. Here we go.
Just been over there in 44-degree heat.
Oh, where'd you go? Was it Vegas you went to? Or?
Yeah, I thought I was prepared, but that was something else.
It's amazing, isn't it? Has the growth in the USA stock prices since 2021 impacted Australian stock performance? Are Australian investors going to the USA stocks rather than our own backyard here?
Yeah, interestingly, I don't think that's the case. I think it's just more generally, I don't think USA stock prices have an impact on Australian stock prices, other than when you go through those periods, like a GFC, for example. Like, we didn't even really have a GFC in Australia. I don't even think we didn't even have a recession. I still remember Michael Lushcombe, the CEO of Woolworths, saying the biggest problem Australians had was how to fit 2 plasma TVs in a shopping trolley. But our share prices got hit like the US stocks did, but nowhere near as bad across the board anyway. So I don't think that's the case. But are there more Australian investors investing abroad now? Well, I think there is, but I think it's very slow and pretty small, to be honest. Like, we started international coverage in our subscription business, was it probably 18 months ago or 15 months ago? We didn't get any big, new subscribers signing up for the international service. So that tells me that people, the only people that are really interested in investing overseas were probably already doing it.
I know you. I
think too, it's interesting. Sorry, Tom, I'll just say, the Australian market doesn't have the growth of the US market, at least in recent years, but it tends to be more stable as well. So it sort of depends what you're looking for.
I know you've spoken about this at length, but it's a good point that Jeff is bringing up, that it's sort of like a permanent distortion of the market now, isn't it? With everyone piling into ETFs, like, they're definitely becoming the choice of a lot of people to enter the market, whether it be for a good reason or a bad reason. I know our InvestSmart brand, we also have managed portfolios that are made up of, passive broad index tracking ETFs. Do you sort of agree, I guess, with what Jeff's saying? It's the permanent distortion now?
Yeah. So, if you listen to David Einhorn at the moment, he's just complaining that he thinks the markets are broken because of this phenomenon. I don't think it's necessarily the case. It's quite that bad. But, I talked earlier about just what the market does best, and it takes a good idea to start with, and then it just completely butchers it to the point where it makes it irrational. And I'd say that's where, ETFs investing is at the moment. Like, what return are you expecting if you buy an ETF at the moment, which is basically just the top 20 stocks? I just talked about Shaw's model, the broker, who's not expecting any capital gains in that portfolio. So I think if you follow that logic right through, basically what you're asking is, okay, it's permanent, but what should you do about it? Basically, you're suggesting, okay, just get on board. Now, I actually wrote in, I think it was our report, maybe it was last month or the month before, that just how ridiculous some of the valuations for some stocks are getting. So CBA being a good example. And, I just position, suggested at some point what happens when the market does turn down. And maybe it's 5 years' time something goes wrong. What do you think is going to happen to the market then? Do you think these ETFs, people are going to be buying the ETFs and bidding up stocks? Like, it's not going to happen. What I think will actually happen is it'll be more like 1987, where one of the reasons cited for the big rapid crash, was it down Black Friday or Black Monday, market was down 25% or something. One of the reasons that happened was because of a fairly new invention at the time. And remember, there's nothing new in financial markets ever. There's only new participants. But it was something they called portfolio insurance. So basically, that was all the algorithms that were set. If the market fell by a certain amount, all the algorithms said, right, sell everything. All right. And that's what I expect will happen with ETFs. You'll go through a downturn, and the downturn will probably be much more rapid and be over faster. A bit like the COVID bear market. It was just everything happened so fast. It was over within like a few days. I think that's what will happen in the future. Is things are just happening much faster than they used to. But the important point is, what are you buying? Are you really just going to sign up in an ETF to earn 3.5% and hope that more ETF buying just sends prices up even further to even further crazier prices? I think that's obviously foolish. So just be very careful about. Yes, it might be a permanent change in the market, but be careful about how you actually react to it.
There's a bit of prognosticating required here. Stephen's just asking, what sectors do you like in this market? What might perform? And he's also just quickly asking about the RBA interest rate movements this year, maybe even going forward, because I know we were speaking even before we aired about how obviously the banks are at multipliers which just seem very high, and that's not even taking into account the fact that interest rates may even drop in the future.
Yeah, so in terms of the RBA, I talked about that a little bit. It seems like we're going to be the last to go down, given there still seems to be an increased bias. But I think they're hoping that they don't have to raise them. It does seem like inflation's going down to relatively low levels. It looks like the US is going to kick off next month. So maybe actually what the bigger effect in the interim might be if the Aussie dollar was to go up a bit. That might impact some of the CSLs and ResMeds and those stocks with big US earnings. But obviously that we only expect that to be a temporary issue. But in terms of what sectors do I like in this market, I think another way of putting this question is, what are some of the contrarian trades that, could work out really well over the next few years? Because basically what's working at the moment is what's been working for the last 5, 10, 15 years. It's just, all the tech stocks and the rapidly growing high quality stocks, they're just going up, and everything else is pretty much getting left behind except for the banks, strangely. But the influence, I've talked about the influences there, and it's got nothing to do with the value. But, coal stocks look really good to us at the moment. The dividends there are still huge, and the sector's consolidating. So there's a lot of value there, which is why New Hope is one of our biggest positions. Lithium and iron ore are getting killed at the moment. I don't think the iron ore companies haven't come down low enough yet for me to want to start buying them. And the lithium stocks have been killed, and the lithium price just keeps falling. So we're going to see consolidation there as well. So in terms of contrarian plays, it's really on an individual stock basis, probably more than sectors. We've had a good look at the A-REIT sector. Just doesn't seem very interesting. The returns, if interest rates start going down, you'd expect the A-REITs to go up, and they've already gone up a little bit. But you might get a bit of a bump, but then after you get into year 2, year 3, year 4, the returns are just abysmal. So I'm not really finding many A-REITs that are particularly interesting.
I guess we're getting very close. So we have run over time, and there still are a lot of questions that were there. What I might even try and do is put them all to you, Nathan. I'll send them to you after this, and you can have a look and see if there's some that you could perhaps answer in a certain way. Nathan's gone through a lot of different stocks in this particular webinar already, but remember, because you've attended, you'll also get that 5 income stocks better than the bank's report. So that will be emailed to you tomorrow, I've been told. So that's got a much more detailed breakdown of those 5 stocks in there. And John Addis has put a lot of time and effort into that one. You can, of course, follow us on social media. the Twitter account, X, I should say, it's one of the best places to get the up-to-date information, because we'll post this on YouTube, but we'll also make posts across our social media. We're also on Facebook, LinkedIn, of course, and we're also even using TikTok and YouTube accounts these days as well. So, Nathan, I was
Don't
going to
worry,
say
anyone, you won't see us dancing on there.
well, we could. We try and do the
No.
ComSec approach or anything. But the offer finishes on the 30th of August next week, 5 p.m. So if you do decide to apply, we'll give you BPay biller code and details, and you can make a payment that way. The minimum investment amount is $2,500 through this actual offer period. So don't leave it to the last minute if you're going to send a large amount. Sometimes your banks may have limits on that. But Nathan, was there anything else you wanted to add? And otherwise, we'll leave it there. Get this edited and up onto the website.
No, thank you, Tom. Thank you, everyone, for listening. And if you do have questions, send them in. We'll do our best to answer them.
Yep, excellent. And I know that Mitch Datson, who is part of the team, was in the comments there just saying before that if you have any questions, you can email invest@intelligentinvestor.com.au. But thanks very much, Nathan. Thank you, everyone who participated, asked questions. We really do appreciate it. All the best of luck.